Hello and welcome to Chapter 2 of The Intelligent Investor, where we're going to be talking about the investor and inflation. So at the start of Chapter 2, Benjamin Graham talks about how inflation has impacted the investor over the past 25 years. So what Graham throws out there is that for his time whenever he wrote this book, in the previous 25 years, inflation had grown at 2.5% every single year. So you might be asking yourself, so what does that mean in graphical terms? And you can see I have a chart here. So if you had $1,000 today and inflation continued to grow at 2.5% every year into the future for the next 25 years, what you'd end up with is almost about half the value that you have today in real buying power. So if you're going to go out and buy some milk, you'd have half that buying power in 25 years to buy the same thing. So that's really what that has an impact on. So when a person sees that, they immediately think that inflation is all bad. But I'm here to tell you that it can be bad in some circumstances and good in other circumstances. So let's talk about the good circumstance first. So whenever you're a home buyer and you're taking out a loan, this is where inflation can actually work for you. As a borrower, it's actually a good thing. So let's take an example here. A loan at 6% interest for a $250,000 house. Let's assume that we have an inflation rate at 2.5%, you're effectively paying a 3.5% interest rate on that house because inflation is eating away at that $250,000 value that lender had originally given you the money for. Now, let's talk about when it's bad. So when we look at that last scenario, the lender was the person who was actually eating that poor performance of the loan because they were lending the money to you. So if you're a bond holder, if you're buying bonds, you're actually the lender. So that's where it is not a good situation. So anytime you buy a bond, it's completely impacted by inflation. So let's take this example of a $10,000 bond that pays a 5% interest rate or 5% coupon. So if you have an inflation rate of 2.5%, that bond is actually going to perform at a 2.5% rate of return. How we figured that out is we take the 5% coupon, we subtract out the inflation for your actual return. So when you take 5 minus 2.5% for the inflation, your interest rate then becomes 2.5%, which is much less than the 5%. So your real par value that you'd get back after a 30-year period on this particular example, instead of getting $10,000 back in real value, you would actually get back $4,679 in real value, which is not good. So that's something that you absolutely got to consider when you're talking about investing in bonds is what's the impact of inflation on this return that I'm expecting to get. So you might be immediately thinking, well, okay, so how does inflation impact stocks? And this is where it gets a little bit tricky. And Graham actually doesn't really provide a lot of concrete information in Chapter 2 to identify inflation's exact results. All he says is that stocks are somewhat impacted by inflation, but not as much as bonds. And he doesn't really specify an exact value, but he does throw out that he thinks that if you are expecting to get higher than an 8% return on the Dow Jones, you're probably not going to get it. So that was Graham's opinion in Chapter 2. Something that I want to highlight is Buffett's opinion on inflation is a little bit more in depth, and he talks about this in his shareholder letters, where he says that stocks are impacted by inflation based on their composition of tangible assets and the consumption of their capital expenditures. So what in the world does that mean? So let's go ahead and demonstrate this. So every company out there has a balance sheet. And whenever you look at the balance sheet, they have intangible assets and liabilities, and they have tangible assets and liabilities. And so what Buffett tries to do is he tries to look at how much is the company having to repurchase certain items. So like with a building, that has a lot of capital expenditures to maintain that and sustain it. Whereas intangible assets don't necessarily have that capital expenditure rate like a tangible asset. In software, they might have upkeep and things like that. But in general terms, he's talking more towards like intellectual property and goodwill and brand and things like that. So what he does is he looks at the balance sheet and he determines how much of this is a tangible asset that's going to have to be replaced and how much of this is intangible assets that are just going to continue to endure in value. After he makes that determination, he feels that the items that have to be continually replenished are the ones that are going to be impacted by inflation. So when we look at the text on there, you can see that I have a split between 50% tangible and 50% intangible. And so what Buffett would say is those tangible assets are going to have to be replaced. And so the inflation rate of 3%, only half of that 3% is actually going to be impacted within the company. So if you were trying to determine how much is this company's annual return going to be, and let's say initially you think it's going to be 10%, Buffett's going to say, well, let's subtract about 1.5% off of that because that's going to be the impact of inflation. He's not going to account for the full 3%. He's going to only account for maybe half of that based off of that composition on the balance sheet. So that might have been a little in-depth for a person who's not real familiar with financial statements or things like that. And if that's the case, don't worry about it. Just take the more conservative approach and apply the full inflation rate to whatever you think you might get on the return for the stock. So at the very end of the chapter, going back into chapter 2, Graham talks about alternatives to stocks to protect against inflation. And so he brings up gold, jewelry, art, a bunch of different things. And in general, Graham says that investing in these types of assets, you're really not getting any kind of return. It'd be the same thing as maybe putting your money in a checking account. So that concludes chapter 2. And what Graham's really saying is that although stocks are not an absolute protection against inflation, they're definitely better than bonds. And if you're investing in bonds, you need to absolutely account for 100% of the inflation coming out of your return. So that's all we've got for chapter 2, and I'm looking forward to seeing you in chapter 3.